One of the biggest fears projected out of the COVID-19 pandemic is the rise in non-performing loans. As businesses struggle with reduced sales due to depressed economic demand, economists fear that many may fail to service acquired debt, and there are already indicators pointing in this direction.
NPLs, we are talking about NPLs, I think, of 5.8% in the month of June. This threatened up from 5.4% in the quarter to March. And the projection indicated that probably this could edge up further in the subsequent quarter.
It is feared that an increase in non-performing loans or NPLs may undermine the intended outcomes of the central bank's stance of monetary easing, as seen in its move on maintaining its benchmark rate for August at 7%. The intended outcome is to encourage banks to lend more to the private sector. But as this happens, even the loan appetite from the private sector remains weak.
We've not seen a lot of growth in the business. If I look at the figures last year, the loan book grew by about 13% across the financial services industry. But if you look at between what happened between 1st January and June, we've barely seen any growth in the loan business across the sector.
So as the central bank pulls all stops to support economic recovery from the impact of COVID-19 measures on its operations, the lack of clarity as to when the pandemic will be brought under control complicates its effort to support economic stability.
The extreme uncertainty characterizes the outlook, which is heavily contingent upon the intensity, spread, and duration of COVID-19 pandemic, particularly the heightened risk associated with the second wave of infections. In these conditions, supporting the recovery of the economy is overriding in the conduct of monetary policy, provided inflation remains in the range of 5% plus or minus 3 percentage points.
With such realities, pundits note that they are now keenly awaiting to see whether inflation would indeed be maintained in single digit, whether effective demand would pick up, and whether this helps businesses bounce back strong to service debt better and flatten or reverse the non-performing loans curve, which seems to be picking pace today.